Okay, tax season. You made some money in the stock market this year. Fantastic. That feels really good. Your portfolio balance is up. Maybe you locked in some nice profits. But then that tax deadline starts looming, right? You think, okay, how do I tell the IRS about this? What forms do I need? And what if some of my investments went down? Can those losses actually help me out here?
Yeah, those are exactly the questions that come up.
It's a part of investing that can definitely feel like navigating a maze, but it doesn't have to leave you feeling lost. Today, we are taking a deep dive into the world of investment taxes, specifically focusing on your U.S. stock market activity. We're going to unpack the forms, the core rules, and yes, even some of the surprising details and potential pitfalls that the source material lays out.
Yeah, pitfalls are definitely something to watch out for.
And these details can make a real difference in how you file.
That's right. We're going to be extracting the most important nuggets of knowledge directly from the sources provided to guide you through understanding what capital gains and losses are, how the IRS taxes them differently, and crucially, how to report them correctly using forms like Schedule D and Form 8949.
Schedule D.
Our mission is to cut through the complexity, helping you gain the clarity you need quickly but thoroughly so you feel informed, not overwhelmed when it comes to reporting your stock market activities.
All right, let's jump right in. So you've hit the sell button on some stock. Ideally, you made a profit. What exactly is a capital gain when we're talking about those shares you just sold? Let's unpack that.
Okay. At its most fundamental level, a capital gain is simply the profit you realize when you sell an asset for more than you paid for it. And the sources we're looking at provide a pretty broad definition of what qualifies as a capital asset. It's not just stocks.
Right.
They mention things like bonds, stakes in businesses, land, cars, boats, artwork, collectibles, crypto, even your personal home, potentially.
Wait. So selling my old car could involve a capital gain. What about, like, my collection of anti-stamps?
That's where a key distinction the sources highlight comes in. And it's a nuance many people might not immediately think about. The IRS differentiates between assets held for investment purposes and assets held for personal use.
Okay. Investment versus personal.
Exactly. If you sell an asset that you held for investment like stocks, bonds, or maybe land you bought specifically hoping it would appreciate and you sell it for a gain, that profit is a taxable capital gain. But if you sell a personal use asset like your car, a boat you used for fun, or yes, that stamp collection you didn't buy as an investment, any gain you make on the sale is generally taxable.
Really? So selling my old car for more than I paid could actually result in a taxable gain?
It could, yeah. It's less common with cars because they usually depreciate, but if it appreciated for some reason, that gain is technically taxable.
Okay, so a gain on a personal item is taxable. That's interesting. But what about losses? If I sell my car for less than I bought it for, or that stamp collection.
And here's the other side of that crucial distinction. If you sell a personal use asset at a loss, that loss is generally not deductible on your tax return.
All right.
This is a significant difference compared to investment assets where losses can be deductible, as we'll get into later. So while you might have a real financial loss on selling your car, it typically won't help your tax bill.
Got it.
The focus of our discussion today, and really of Schedule D, is primarily on those investment assets like stocks.
That makes sense. So if I sell my stock and make money, it's a taxable capital gain. If I lose money, it's a capital loss, and that might be deductible because stock is an investment asset.
Right.
And all of this only matters when I actually sell the stock, right? Not just because my brokerage statement shows the value went up this year.
Exactly right. The sources are very clear on this. A capital gain or loss is a realized event. It only happens and therefore only triggers a potential tax consequence at the moment you sell or, otherwise dispose of the asset.
So if my portfolio looks great on paper, but I haven't sold anything,
no capital gains tax due yet. If your stock portfolio grew significantly in value over the past year, but you didn't sell any shares, you generally don't owe capital gains tax on that appreciation until you actually do sell. It's the act of selling that matters for tax reporting on Schedule D.
Okay, realized gain or loss upon sale.
Got it.
So how do I calculate the size of this gain or loss? It sounds like pretty basic math.
The core calculation is indeed quite simple. It's your sale proceeds minus your tax basis. That tax basis is most commonly referred to as your cost basis.
Cost basis. What goes into that? What's included?
Your cost basis is essentially your original investment in the asset for tax purposes.
Hmm.
Typically, it's the price you paid to acquire the asset for stocks. That's your purchase price per share times the number of shares. Plus, any costs directly associated with the purchase, like brokerage commissions or fees, those get added in.
Okay.
This total figure is your starting point, your basis, for determining whether you have a gain or a loss when you sell.
So, quick example. If I buy 100 shares of XYZ stock at $50 a share, that's
Yeah.
$5,000. And let's say I paid a $7 commission. My cost basis for those 100 shares is $5,007. If I later sell those shares for $60 a share, getting $6,000, my capital gain is $6,000 minus $5,077, which is $993.
Precisely. That's your taxable gain.
Okay.
And following the same logic, if you sold those same 100 shares for $40 each, receiving $4,000.
Then it's $4,000 minus the $5,007 basis.
Right, resulting in a $1,077 capital loss. That calculation sale price minus cost basis is the fundamental step for every single stock sale.
Simple enough for one transaction. Now, here's where it gets really interesting and where the sources spend a lot of time emphasizing a critical point. The calendar is your tax guide. We're talking about your holding period. Why does the length of time you hold on to that stock matter so dramatically for tax purposes?
Oh, it matters hugely because your holding period determines whether your capital gain or loss is classified as short-term or long-term. And those two classifications, short-term and long-term, are taxed at potentially very different rates. This is probably one of the most fundamental concepts to grasp when it comes to investment taxes.
Okay, let's break down those two categories then. What defines a short-term capital gain or loss?
Short-term applies if you held the asset for 1 year or less before you sold it.
1 year or less.
Yes. And the sources are quite specific on how to calculate this holding period. It starts the day after you acquire the asset and includes the day you sell it.
Okay, the day after you buy includes the day you sell. So if I buy a stock on June 15th of this year and I sell it on June 14th of next year, is that short-term or long-term?
That would still be short-term, exactly 1 year. You need to hold it for more than 1 year for it to qualify as long-term. So if you buy on June 15th, you'd need to sell on or after June 16th of the following year to meet that more than 1 year requirement.
Gotcha. More than a year.
The sources give a helpful example. Buying 100 shares of Disney stock on April 1st and selling them on August 8th of the same year clearly falls within the 1 year or less window. That's short-term.
Got it. 1 year or less is short-term? And the tax rate for a short-term capital gain, how's that figured?
Short-term capital gains are generally taxed at your ordinary income tax rate.
Ordinary income. So the same rate as my paycheck.
Exactly. It's the same tax rate that applies to your wages, your salary, or maybe interest income you earn from a savings account. It just gets added to your other income.
So it's taxed at my regular income rate, the one based on my tax bracket.
Precisely. And those ordinary income tax rates, as you know, can range significantly currently from 10% up to 37%, depending on your total taxable income and your filing status.
Right.
This is why short-term capital gains are typically considered less tax advantageous than long-term gains. They're taxed at potentially the highest rates you pay on any income.
Which brings us to long-term. That's holding the asset for more than 1 year, you said.
Correct. Held for more than 1 year.
And the big benefit here is the lower tax rate. This feels like one of those key nuggets the sources really want us to highlight.
It absolutely is. Yeah, this is where the potential for significant tax savings comes in. Long-term capital gains are generally taxed at lower preferential rates.
Preferential rates, okay.
The sources specify these rates are typically 0%, 15%, or 20%. For many investors, this difference between their ordinary income rate and the long-term capital gains rate can be substantial, really substantial.
Can you walk us through those specific rates and the income thresholds that apply? The sources provide them for the 2024 tax year, which is what people will be filing in 2025. These thresholds seem critical.
Happy to, yeah. Knowing these is key. For the 2024 tax year, filed in 2025, the long-term capital gains rates are determined by your taxable income and your filing status. So the 0% long-term capital gains rate applies if your taxable income is up to $47,025 if filing single, $63,000 if filing head of household, $94,050 if filing married filing jointly, and $47,025 again if married filing separately.
Wow, 0% tax on gains if your income is below those levels. That's huge.
It really is. Then the 15% rate applies to taxable income above those 0% thresholds, up to $518,900 for single filers, $551,350 for head of household, $583,750 for married filing separately.
Okay, so a big chunk of earners fall into that 15% bracket for long-term gains.
That's right. And finally, the 20% rate applies to taxable income above those 15% thresholds. So over $518,900 for single, over $551,350 for head of household, over $583,750 for married filing jointly, and over $291,850 for married filing separately. What's fascinating here, as you noted, is how these income thresholds work. For individuals or couples with lower taxable income, realizing a long-term gain can be entirely tax-free.
Incredible.
And even for those in higher ordinary income tax brackets, like say the 32% or 35% bracket, paying only 15% or 20% on long-term gains is a significant saving compared to their regular rate. And the sources do note these brackets get adjusted slightly for inflation each year, as they show for the upcoming 2025 rates too, so it's good to keep an eye on them for planning.
That 0% rate really underscores the importance of that holding period, especially for retirees or lower earners. But I know the sources mention a couple of exceptions to these standard long-term rates, right? It's not always 0, 15, or 20.
Correct. There are important nuances for certain types of long-term gains. The sources point out gains from the sale of collectibles, things like rare coins, stamps, art, antiques. They're generally taxed at a maximum rate of 28%.
28% for collectibles.
Okay. And also, gains from selling certain real property where you previously claimed depreciation, that portion of a gain is taxed at a maximum rate of 25%. So while the 0152 framework covers most stocks and bonds, these exceptions are definitely worth noting if you hold those kinds of assets.
Good to know there are special rules for things like selling that valuable painting or certain real estate. And for higher earners, there's another layer, right? The net investment income tax.
Yes, that's another critical point the sources bring up, connecting investment taxes to the broader tax picture for higher earners. Individuals with modified adjusted gross income, MAGI, above certain thresholds are subject to an additional 3.8% tax. It's called the net investment income tax, or NIT.
And what are those income thresholds?
The thresholds are $200,000 for single filers, $250,000 for those married filing jointly, and $125,000 for married filing separately.
So for high-income individuals, this 3.8% tax is added on top of the regular capital gains rate.
Exactly. If your income is above the threshold, your investment income, including your capital gains, unless maybe an exception applies, could be subject to this additional tax.
Wow.
So a long-term gain could actually be taxed at 18.8%, that's 15% plus 3.8%, or 23.8% plus 3.8%, or even that collectible rate plus the NIT. It significantly increases the overall tax bite on investment income for high earners and connects this specific tax back to their total income situation.
Okay, so we've identified gains and losses, figured out if they're short or long-term based on holding period, and we know the potential tax rates, including NIT. How does the IRS want you to actually report all this stuff? This is where the forms come in, specifically Schedule D.
Yes, Schedule D, its formal title is Capital Gains and Losses, is the central form for reporting these transactions. The sources describe it as an essential part of your tax return if you sold or traded property classified as a capital asset during the year. Pretty much anyone selling stocks needs it.
And often, Schedule D works hand in hand with another form, Form 8949, right?
Yeah.
What's the relationship there? How do they work together?
That's right. Form 8949, Sales and Other Dispositions of Capital Assets, is typically where you list the details of each individual transaction.
Okay.
Think of Schedule D as the summary form where you calculate your overall net gain or loss, and Form 89949 is the supporting document. It's where you provide the specifics for every single sale that feeds into that summary on Schedule D.
So if I sold, say, 15 different stocks throughout the year, I'd need to list all 15 of those sales individually on Form 8949. That sounds like a lot of typing.
In most cases, yes, that's exactly right. For each sale, you'll typically report on Form 8949 the name of the company or asset, the date you originally acquired it, the date you sold it, your cost basis for the shares sold, and the price you received from the sale.
All those details for each one.
Yeah, this level of detail allows the IRS to verify the calculation of your gain or loss for each transaction. But this brings up an important point the sources highlight. Do you always have to list every single stock sale individually on Form 8949?
I remember the sources mentioning something about the Form 1099-B you get from your broker. That seems like a key simplification for some transactions, maybe.
Exactly. This is a crucial practical detail. Your broker reports sales information to both you and the IRS on Form 1099-B, proceeds from broker and barter exchange transactions. The sources note an exception where you might be able to summarize certain transactions directly on Schedule D without needing to list them one by one on Form 8949.
Oh, that sounds promising. When does that apply?
It applies if, 1, you received a Form 1099-B from your broker. 2, the 1099-B shows that the cost basis of the shares was reported to the IRS. You'll usually see a checkmark or info in box 3 for this. And 3, there are no adjustments needed to the basis, gain, or loss for that transaction.
No adjustments needed. What kind of adjustments might be needed?
Things like adjustments for wash sales, which we'll definitely get into, or maybe if the basis reported by the broker was incorrect for some reason.
Okay, so if the 1099-B shows basis reported to IRS and there are no funny adjustments,
then yes, you might be able to report the total proceeds and total basis for that category of transactions directly on Schedule D, like in summary lines 1A or 8A. But, and this is a big but, you need to carefully review your 1099-B. If the basis wasn't reported to the IRS, maybe box 3 is unchecked or says N, or if you do need to make any adjustments yourself,
then you have to use Form 8949.
Then you must list those transactions individually on Form 8949. So the 1099-B is your starting point, your guide, but it doesn't eliminate your responsibility to ensure accuracy and make adjustments if they're needed. You still have to check it.
That's a really helpful clarification. The 1099-B simplifies things if everything is straightforward, but you still need to verify. And I assume both Schedule D and Form 8949 keep short-term and long-term separate.
Oh, absolutely. They are structured to do just that. Both forms are typically divided into parts or sections. One for short-term transactions, assets held 1 year or less, and one for long-term transactions, assets held more than 1 year.
Right.
This separation is vital because it helps you first calculate your total net short-term gain or loss and your total net long-term gain or loss separately. You figure those out first.
Before you combine them.
Exactly. Before combining them later on Schedule D, to arrive at your overall net capital gain or loss for the year. The separate categories are essential for applying the correct tax rates. Remember, short-term is ordinary, long-term is preferential, and also for the netting process when you have both gains and losses, which we'll talk about.
Okay, let's circle back to that idea of cost basis. We said it's usually purchase price plus fees, but you hinted earlier that it can get a little more complicated, a little digested sometimes.
That's right. While the purchase price is the starting point, what's fascinating here, and really crucial for accurate reporting, is how other events can legitimately change your cost basis over the time you own the investment. It's not always just that initial number you paid.
What kind of events would change the cost basis of stock? What are we talking about?
Well, one common one mentioned in the sources is a stock split. Let's say the company you own stock in has a 2-for-1 split.
Okay.
This event itself, the split, is generally not a taxable event. You don't report income just because you suddenly have more shares.
Right. Feels like you haven't really gained anything yet.
Exactly. But what happens from a tax basis perspective is that your total cost basis for your entire investment in that stock remains the same, but it gets reallocated among the increased number of shares.
Okay, so using my earlier example, 100 shares bought for a total cost basis of $5,007. That was $50.07 per share. If that stock splits 2-for-1, I now have 200 shares. But my total basis is still $5,077. So my new cost basis per share is $5,077 divided by 200 shares, which is 25.035 cents per share.
Exactly right. Your per share basis gets cut in half in a 2-for-1 split. The source used a pizza analogy. You haven't gained more pizza, you just have more slices now. Each slice, or share, represents a smaller portion of the total value, and so the cost basis per slice is lower.
That makes sense. Good analogy.
You only report a gain or loss when you eventually sell those 200 shares, and you'll use that adjusted per share basis of 25.035 thousand to calculate your profit or loss.
Got it. So stock splits adjust the per share basis. Another thing that comes up in the sources regarding basis adjustments is reinvested dividends. How do those affect your cost basis?
Reinvested dividends. Very common, especially with mutual funds or dividend reinvestment plans, DRIPs. When you receive dividends and you choose to have them automatically used to buy more shares of the same investment, that money used to buy those additional shares increases your cost basis. Essentially, you're using income, the dividend, which is often taxable itself in a regular brokerage account, to acquire more of that asset. Each reinvestment is like a new little purchase.
Why is it critical to track and include reinvested dividends in your cost basis? Why does that matter so much?
Because if you don't, you could end up paying tax twice on the same money.
Ouch.
Well, first, you might pay ordinary income tax or qualified dividend tax on the dividend itself when it's paid out, assuming it's in a taxable account. That's tax number one. Second, if you don't add the cost of the shares bought with that dividend to your overall basis, your basis will be artificially low. When you eventually sell all your shares, your calculated capital gain will be higher than it should be because you didn't account for those extra purchases.
So you pay capital gains tax on the portion of the gain that really just represented those dividends you already paid tax on.
Exactly. That would be a nasty surprise. You definitely want to make sure those reinvested amounts are included in your total basis.
Does my broker usually track that?
Your broker should track this and include it in the basis reported on your 1099-B, especially for shares purchased more recently where basis reporting is mandatory. But for older shares, or if you moved accounts, it's still really important to understand how it works and ideally verify its accuracy yourself. Don't just assume the 1099-B is perfect.
Good advice. Check the broker's math.
Always a good idea. Now, to add another layer of, let's say, fun complexity, the sources also discuss that there are different IRS-accepted methods for tracking your cost basis. This comes up especially when you've bought shares of the same asset, like a mutual fund or a stock, at different prices over time.
Different methods. Why would that matter? Doesn't the math just work out the same in the end anyway? If I bought shares for $10 and shares for $20, isn't my total cost just the sum?
Well, yes, your total cost is the sum, but this is a fascinating point, and it raises an important question. Which method should you use when you sell only some of those shares, or even all of them? The sources highlight that the method you choose before you sell can significantly impact the taxable gain or loss you report in a specific year.
Really? How?
Even if your total investment and eventual total gain or loss over the very long run might be the same, the timing of when you recognize gains or losses can differ dramatically based on the method. This choice can have real tax consequences in the year of the sale.
Okay, I'm intrigued. What are some of these methods the sources list?
The sources list several. Average cost, first in, first out, which is FIFO, last in and first out, LIFO, high cost, and low cost.
Okay, FIFO, LIFO. Sounds like accounting class.
Kinda, yeah. Average cost is a very common method and often the default election brokers use for mutual funds. It just averages the cost of all your shares. FIFO, or first in, first out, is the default method the IRS assumes you use if you don't specifically tell your broker otherwise before the sale. FIFO assumes you sell the shares you acquired earliest first.
Let's go back to that example from the source about the 1,000 shares of a mutual fund bought at different prices. It really illustrates the difference these methods can make, right?
It's a powerful illustration. Yeah, let's walk through it carefully. Imagine you own 1,000 shares total of some mutual fund. You bought 500 shares way back when at $20 per share. And later, maybe the market dipped, you bought another 500 shares at only $8 per share.
Okay, so 500 at 20, 500 is at $8.
Your total investment, your combined basis, is $520 plus $508. That's $10,000 plus $4,000, which equals $14,000 total basis for your 1,000 shares.
Your $18,000 cost.
Yeah.
Got it.
Now, suppose you decide to sell all 1,000 shares today, and the price is currently $19 per share. So you receive $19,000 total from the sale.
Okay, $19,000 sale price, $14,000 total cost basis. Seems like a $5,000 gain overall.
It is a $5,000 gain overall, but how that gain is reported and potentially taxed this year depends on the cost basis method applied to the specific shares deemed sold. The sources show the results using different methods for selling all 1,000 shares using the average cost method. The source calculates the average cost basis per share as $13.33. That's the $14,000 total basis divided by 1,000 shares. If you sell all 1,000 shares using this method, your gain is $19 sale price minus $13.33 average basis times 1,000 shares, which comes out to a $5,670 gain. Slightly different from the simple five-tailist due to rounding in the example's average basis made.
Okay, $5,670 gain with average cost.
Now, using FIFO, first in, first out. The IRS default assumes you sell the shares you bought first. In this case, those were the 500 shares bought at $20. The source calculation applies this $20 basis. $19 sale price minus $20 basis times 1,000 shares results in a $1,000 loss.
Wow. A loss, even though I sold for more than my total cost.
Because FIFO specifically identifies those first high-cost shares as being sold. Now, using LIFO, last in, first out, you're considered selling the shares you bought last, the ones at $8. The source calculation uses the $8 basis, $19 sale price minus $8 basis, times 1,000 shares. Huge $11,000 gain.
Whoa, from a loss to an $11,000 gain just by switching method.
Exactly. And it continues. Using the high-cost method, also called HFO, highest in, first out, you specifically identify and sell the shares with the highest cost basis first. Here, that's the $20 share, so same result as FIFO in this case, $1,000 loss.
Okay.
And finally, low cost, or LIFO, lowest in, first out. You sell the shares with the lowest cost basis first, that's the $8 shares. Same result as LIFO here, $11,000 gain.
That is stunning. Selling the exact same 1,000 shares for the exact same $19,000 can result in reporting either an $11,000 gain or a $1,000 loss in the year of the sale, purely based on which cost basis method is applied. That's truly eye-opening.
It really.
It feels like you could strategically pick the method that gives you the best tax outcome for that year.
Exactly. And that's the key conclusion from the source material on this. The method chosen before selling can significantly impact the taxable gain or loss you report this year. You absolutely might strategically prefer, say, the high-cost method if you want to generate a loss or minimize gains in a particular year to reduce your tax liability. Or maybe use low cost if you're in a low tax bracket that year and want to realize more gain.
What's the catch? Can I just decide after I sell?
No, that's the catch. You usually have to elect a specific identification method with your broker either at the time of sale or have a standing election in place, like average cost for mutual funds. You can't typically decide after the sale which shares you sold just to get the best tax number.
So you need to plan ahead with your broker if you want to use something other than their default or FIFO.
Correct. Especially if you're selling only part of a position bought over time. You need to tell them which specific shares to sell, based on purchase date or cost. If you want to use specific identification like high cost or low cost, it requires proactive management. This example really underscores that tracking basis, especially with multiple purchases, adjustments like reinvested dividends or different methods, can become complex.
Definitely seems that way.
And while brokers do report basis on the 1099-B now, ensuring its accuracy, accounting for adjustments maybe the broker missed, like for very old shares, or properly selecting and documenting a specific ID method still requires careful attention. If your investment history is complex, talking to a tax advisor can be invaluable here.
Okay, let's pivot to something that feels bad on your portfolio statement, but can actually be a silver lining for your taxes. Losses. Nobody enjoys losing money on an investment, right?
No, definitely not.
But these capital losses aren't just setbacks. The tax code allows them to be valuable tax reducers.
They absolutely can be. The IRS provides rules for how you can use capital losses to offset capital gains and even potentially reduce your other ordinary income. It's a key part of the tax system for investors.
How does that netting process work if I have both gains and losses in a single year? How do they match up?
There's a specific order to follow, which Schedule D helps guide you through. First, you net your short-term capital losses against your short-term capital gains.
Short-term versus short-term first.
Okay. If you have more short-term losses than gains, you have a net short-term capital loss. If more gains, a net short-term capital gain. Simple enough. Separately, you do the exact same thing for your long-term transactions. Net long-term losses against long-term gains to find your net long-term result.
Okay, so STV is ST, LTV is LT. Then what?
After netting within those short-term and long-term categories, you then combine the net results. If you have a net gain in one category, say long-term, and a net loss in the other, say short-term, you net those against each other to get your overall net capital gain or loss for the year.
Can you give an example?
Sure. The sources provide one.
Wow.
Let's say you have a net short-term loss of $2,000 and a net long-term gain of $3,000.
Okay, $2 KST loss, $3K LT gain.
You combine them. The $2,000 short-term loss is used to offset $2,000 of the $3,000 long-term gain. The result, an overall net capital gain of $1,000, $3,000 gain minus $2,000 loss. And that remaining $1,000 keeps its character as long-term.
So I'd only pay tax on that resulting $1,000 net long-term gain at the lower long-term rates.
Precisely. The losses effectively shield some of your gains from tax. That's the first benefit.
That's helpful. What if, after all that netting short versus short, long versus long, then combining my overall calculation results in a net capital loss for the year? Like my total losses were bigger than my total gains.
This is where the really powerful part for your tax return comes in. If your total capital losses for the year exceed your total capital gains, resulting in an overall net capital loss,
Yeah.
you can use a portion of that loss to reduce your other taxable income like your wages or salary.
Wait, really? You mean I can use investment losses to lower the income I earn from my job, which is taxed at those higher ordinary rates? How much can I use?
Yes, exactly. This is a key tax benefit. You can deduct up to $3,000 of your net capital loss per year against your ordinary income.
$3,000 a year.
$3,000 per year. If you are married filing separately, the limit is half that, $1,500 per year. This deduction reduces your taxable income dollar for dollar up to that limit.
So if I have a $5,000 net capital loss, I can use $3,000 of it to reduce my taxable salary.
Correct. That can save you tax at whatever your highest marginal ordinary income rate is. It's one of the few ways investment performance can directly reduce tax on your earned income. Very valuable.
$3,000 per year against ordinary income. Okay, what if my net loss is more than $3,000? Say I had that $5,000 net loss. I used $3,000 this year. What about the other $2,000? Is that excess loss just gone forever?
No, thankfully. Any net capital loss exceeding the $3,000 or $1,500 annual deduction limit is not lost. The sources explain that you can carry that excess loss forward to future tax years.
Carry it forward.
Yep. It becomes a capital loss carryover. It's essentially, like you said earlier, a tax-saving credit that you can bank and use in future years.
How does the carryover work in those future years then? How do I use it?
In future years, the carried over loss retains its character, short-term or long-term, and is first used to offset any capital gains you realize in that future year. Short-term carryovers offset short-term gains first, long-term offset long-term gains first, then they can offset the other type.
Okay, so it offsets future gains first.
Right. For instance, if you have a $10,000 loss carryover rolling into next year and you realize a $5,000 capital gain next year, you use $5,000 of the carryover to wipe out that gain. Your taxable gain becomes zero.
And I'd still have $5,000 of carryover left.
Exactly. You'd have $5,000 of loss carryover remaining. Now, if, after offsetting any gains in that future year, you still have a loss carryover balance remaining, like that 5GL, you can then use up to another $3,000, $1,500 MFS of the remaining loss to reduce your ordinary income in that future year, just like you did in the first year.
Oh, okay.
And any amount still left over after that gets carried forward again to the next year. This process continues year after year until the entire loss carryover is fully used up, or, well, until you pass away.
It really is like a future tax benefit you can bank and use systematically. That's great. Are there specific rules about losses in unusual situations, like if a company's stock becomes completely worthless? They go bankrupt?
Yes, the sources addressed this specific situation. If stock in a company you own becomes totally worthless, typically because the company goes bankrupt and liquidates with nothing left for shareholders, you can claim a capital loss equal to your entire cost basis in that stock. It's treated as if you sold the stock for $0 on the last day of the tax year in which it became worthless.
Okay, so I can take the full loss. But how do I prove it became worthless?
That's the key requirement. You need documentation to prove to the IRS that the stock truly became worthless in that specific tax year. You can't just decide it's worthless.
What kind of documentation would the IRS look for?
The sources suggest things like financial statements showing the company has zero equity value, maybe a formal notification from a bankruptcy trustee that the stock is canceled or has no recovery value, or even evidence that the stock is no longer traded on any exchange and has no quoted value. A practical step many investors take, if possible, is to actually sell the worthless stock for a nominal amount, even just a penny per share.
Sell it for a penny. Why?
Selling it, even for almost nothing, provides clear documentation of the sale date and the sale price, zero or close to it. It definitively proves you realized the loss, and importantly, that you no longer have any equity interest in the company. You generally can't claim a stock is worthless if you're still holding on to the shares, hoping for some miraculous recovery. Selling finalizes it.
Okay, so concrete proof, like a sale, is key for a worthless stock loss. And just to reiterate one more time, these valuable loss rules, the offsetting gains, the $3K deduction, the carryover, this all primarily applies to investments in regular taxable brokerage accounts, right? Not my IRA or my personal car.
Precisely. It's crucial to remember the distinctions. Losses on personal use assets, like your car or boat, are generally not deductible at all. And furthermore, capital losses that happen inside tax-advantaged retirement accounts, like your IRAs or 401k, those losses generally cannot be used to offset gains or other income on your personal tax return outside of that retirement account.
So if my IRA balance goes down, I can't claim that loss on Schedule D.
Correct. Those powerful loss deduction and carryover rules are primarily benefits associated with investments held in taxable accounts.
Okay. Given that capital losses can be such a valuable tax tool in taxable accounts,
Right.
It makes sense that savvy investors often use a strategy built around this. The sources call it tax loss harvesting.
It is, yeah. Tax loss harvesting is a common year-end tax planning strategy, though you can do it anytime. It's where investors intentionally sell investments that have declined in value below their cost basis.
To lock in the loss.
Exactly, to realize or harvest that capital loss for tax purposes.
What's the main goal behind doing that? Why intentionally sell losers?
The primary purpose is to generate capital losses that can then be used to offset any capital gains you might have realized during the same year, thereby reducing or even eliminating the tax on those gains.
Okay, offset gains. What if I don't have gains or my losses are bigger?
If your harvested losses exceed your gains, then the excess loss, up to that $3,000 limit we discussed, can be used to deduct against your ordinary income, which is often taxed at higher rates. So it saves you tax there too.
And when is this strategy most effective, tax-wise?
It's particularly tax efficient when you can use harvested losses to offset short-term capital gains because those gains would otherwise be taxed at your potentially higher ordinary income rates. Using losses to get that $3,000 deduction against ordinary income is also highly tax efficient, saving tax at your top marginal rate.
Makes sense. Save tax at the highest rate possible.
The sources also mention another benefit for higher earners. Strategically realizing losses can help reduce your modified adjusted gross income, MEGI. Lowering your MEGI could potentially help you avoid or reduce the impact of that 3.8% net investment income tax we discussed earlier. So it's a way to proactively manage your overall tax liabilities stemming from your investment activities.
That seems like a really smart tax strategy. But of course, the IRS isn't dumb. They have rules to prevent you from abusing this, right? You can't just sell a stock for the loss and instantly buy it right back just for the tax break.
No.
That brings us to a critical pitfall, the wash sale rule. This sounds important.
Yes, the wash sale rule. This is perhaps one of the most important and sometimes, frankly, surprising insights from the sources that investors need to be keenly aware of, especially if you're thinking about tax loss harvesting.
Why? What's it designed to do?
It's specifically designed to prevent you from getting a tax deduction for a loss, while essentially maintaining uninterrupted ownership or economic exposure to the investment you just sold. They don't want you claiming a loss on paper when your real investment position hasn't changed.
Okay, so define a wash sale for us. What exactly triggers this rule?
A wash sale occurs if you sell a security stock, bond, option, ETF, mutual fund at a loss. And then, within a specific time frame, you buy the same security or a substantially identical security.
Okay, sell at a loss, then buy back something the same or very similar. What's the time frame?
It's a 61-day window centered around the date of the sale where you realize the loss. That window includes the 30 days immediately before the sale, the day of the sale itself, and the 30 days immediately after the sale.
Wow, 61 days total. 30 days before the sale day, 30 days after. That's the period to watch out for any repurchase. What's the consequence if I do trigger a wash sale within that window?
If a transaction is determined to be a wash sale, the loss you realize from the sale is disallowed for tax purposes in the current tax year.
Disallowed?
Yeah.
So the loss is just gone. I don't get the tax benefit at all. That sounds bad.
You don't get to claim the loss now in the current year. But thankfully, it's not usually gone forever. The wash sale rule includes a kind of compensation mechanism.
Oh. How does that work?
The amount of the disallowed loss is added to the cost basis of the replacement security you bought, the one that triggered the wash sale.
Added to the basis of the new shares.
Okay. Furthermore, the holding period of the original security you sold at a loss is added, or tacked on, to the holding period of that replacement security.
Okay, that sounds complicated. Let's walk through the example the source uses to really see how this disallowed loss and basis adjustment and holding period thing works.
Okay, good idea. Imagine you bought 100 shares of XYZ stock for $10 per share. Total cost basis $1,000. The price drops. You sell those 100 shares for $8 per share, receiving $800. You have a realized loss of $200. $1,000, $800 sale.
$200 loss realized. Okay. Now, crucially, within that 61-day window, let's say just 2 weeks after the sale, you think, hey, XYZ looks cheap now, and you buy back 100 shares of the exact same XYZ stock. Maybe it's now trading at $6 per share, so you spend $600.
So you sold at a loss, $200 loss, and bought back the identical stock, $600 purchase, within 30 days after the sale. That sounds like a textbook wash sale.
It absolutely is. So the $200 loss you realized on the sale at $8 is disallowed. You cannot deduct that $200 on your tax return for the year you sold it.
Okay, no deduction this year. But you said it's not gone forever.
Right. That disallowed $200 loss gets added to the cost basis of the new shares you just bought for $600.
Yeah.
So your adjusted cost basis for those new 100 shares isn't just the $600 purchase price, it's $600 plus the $200 disallowed loss, making your new basis $800.
So the basis of the replacement shares is higher. How does that help me later?
It helps you by reducing the taxable gain or increasing a potential future loss when you eventually sell those replacement shares way down the road. For instance, if you later sell those shares that have the adjusted $800 basis for $1,000. Yeah.
Your taxable gain would be $1,000 sale price minus $800 adjusted basis equals $200 gain. If the wash sale hadn't occurred, your basis would have just been the $600 purchase price, and your gain would have been $400. $1K, $600. So the disallowed loss effectively reduces your taxable gain later on. It defers the loss recognition.
Okay, that makes sense. It delays the benefit rather than eliminating it. What about the holding period tacking? How does that work in the example?
Good question. Suppose you held the original XYZ shares for, say, 10 months before you sold them at that $200 loss. Then you bought the replacement shares 2 weeks later, triggering the wash sale. The sources explain that your holding period for those new shares normally starts the day after you bought them. But because of the wash sale, the 10-month holding period from the original shares you sold is tacked on to the holding period of the new shares.
So the clock doesn't restart at 0.
Nope. So if you hold the replacement shares for just, say, 3 more months before selling them, your total holding period for tax purposes is the original 10 months plus the new 3 months, equaling 13 months.
Which is more than a year.
Exactly. This could make a gain on the sale of those replacement shares qualify as a long-term capital gain, taxed at those potentially lower rates, even though you only physically held the specific shares you sold for 3 months. That tacking on of the holding period is a significant and sometimes beneficial part of the wash sale rules mechanics.
That holding period tacking is a crucial detail. Could definitely change a short-term gain into a long-term one faster. Now, you mentioned the rule applies if you buy the same security or a substantially identical one. What securities does the wash sale rule cover, and what exactly counts as substantially identical? That sounds fuzzy.
It is a bit fuzzy. The sources indicate the wash sale rule applies broadly to stocks, bonds, ETFs, mutual funds, and options contracts. Generally, if it has the same CUSIP number, that unique identifier, it's considered the same security. As for substantially identical, you're right, the IRS hasn't provided a precise black and white definition. This requires investors and their advisors to use judgment based on the facts and circumstances.
So what's an example of something that probably is and something that probably isn't substantially identical, according to the source?
Rick, okay, the source gives a good example. If you sell an ETF that tracks the S&P 500 index at a loss, and then you immediately buy shares in a different ETF, one that tracks a completely different broad market index, like maybe the Russell 1000 index, those would likely not be considered substantially identical because they track different underlying market segments, even if they're both large-cap U.S. stock ETFs.
Okay, different broad index, probably okay. What about something closer?
However, if you sold one S&P 500 index ETF, say, from Vanguard, and immediately bought shares in a different S&P 500 index ETF, say, from iShares, the IRS might very well consider those substantially identical because they aim to replicate the performance of the exact same index.
Ah, okay. That's much closer.
That's why investors need to be really careful here. If you sell Ford stock, buying GM stock is clearly not identical. But selling one tech sector ETF and buying another tech sector ETF, or two different short-term corporate bond funds tracking very similar benchmarks, the line can get blurry. You generally want to ensure the replacement asset is different enough in its fundamental characteristics or tracking benchmark to safely avoid the rule if you want to claim the loss now.
Definitely requires some thought.
And here is perhaps one of the most critical, almost sneakily important insights the sources highlight about the wash sale rule, and it trips up so many investors. It applies across all of your accounts.
Across all accounts. What does that mean practically? Like my checking account?
Not checking, but all your investment accounts. It means the rule isn't limited to just activity within a single brokerage account. If you sell a security at a loss in your regular taxable brokerage account, and within that 61-day window, you buy the same or a substantially identical security in a different taxable brokerage account you own, or critically in your traditional IRA or Roth IRA, or potentially even in your spouse's account if filing jointly. Any of those repurchases can trigger the wash sale rule for the loss you took in the taxable account.
Wow. So even buying it back in my IRA accounts, my broker wouldn't even know I did that, right? They only see the sale in the taxable account.
Exactly. Your broker is typically only required to track and report wash sales that occur with the same CUSIP number within the same account. They generally won't know, and therefore won't flag on your 1099-B, if you triggered a wash sale by buying the identical stock back in your IRA at a different firm, or even in your spouse's account.
So even if my 1099-B doesn't show a wash sale adjustment for the loss in my taxable account because the repurchase happened somewhere else entirely, the IRS rule still applies to me, and it's my responsibility to figure that out and report the loss as disallowed.
Absolutely. That is the crucial takeaway here. It is your responsibility as the taxpayer to track all your relevant trading activity across all your accounts, taxable, IRAs, potentially spousal accounts, to determine if a wash sale occurred according to the IRS definition.
And what happens if I trigger it by buying back in an IRA? You said the disallowed loss gets added to the basis of the replacement. But basis doesn't really matter inside an IRA for taxes, right?
Precisely. And that's what makes triggering a wash sale by repurchasing in an IRA particularly punitive. The loss in your taxable account is disallowed. But since basis adjustments inside an IRA have no tax consequence, gains aren't taxed annually, losses aren't deductible, you effectively permanently lose the tax benefit of that capital loss. You can't add it to the IRA basis in any meaningful way.
Ouch. So definitely don't buy back in your IRA within 30 days if you just sold for a loss in your taxable account. That's a huge heads up.
It's a very common and costly mistake. Big takeaway.
And just to be clear, the wash sale rule doesn't magically reset at the end of the calendar year, correct? Like selling Day 15th and buying Jan 4th.
That is another point the sources make clear. The 61-day window is a rolling period. It doesn't care about December 31st. If you sell a security at a loss on December 15th of year 1, and you buy it back on January 4th of year 2, that repurchase is still within the 30-day window after the sale. It will trigger a wash sale.
So the loss I took in year 1 would be disallowed for year 1's taxes.
Correct. The tax benefit of that loss gets deferred until you eventually sell the replacement shares bought in year 2 with the adjusted basis and tax holding period.
Okay, the wash sale rule is definitely a key pitfall with tax loss harvesting. Are there other rules about disallowed losses mentioned?
Yes. The sources briefly mention one more common rule designed to prevent artificial losses. You generally cannot deduct capital losses if you sell the security to a related party.
Related party. Like who?
This includes relatives like your spouse, children, grandchildren, parents, grandparents, or siblings. It can also include corporations or partnerships you control. Selling stock to your brother at a loss, for example, that loss would likely be disallowed.
Okay, another anti-abuse rule. Makes sense.
It's another measure by the IRS to prevent taxpayers from trying to create tax losses within a family or closely related group without a true change in economic ownership moving outside that group.
And finally, with all these detailed rules about basis adjustments, holding periods, wash sales across accounts, loss carryovers, keeping good records seems pretty critical, doesn't it?
Absolutely essential. Yeah, the sources implicitly and explicitly stress the importance of meticulous record keeping.
Yeah.
You need documentation for every sale, the date, the price, and most importantly, proof of your accurate cost basis.
Especially if it's adjusted.
Yes. If your basis is adjusted due to stock splits or years of reinvested dividends or disallowed wash sale losses being added back to basis, you absolutely need records to support those adjustments, especially if the broker's 1099-B doesn't reflect them perfectly. And if you have capital loss carryovers stretching over multiple years, you need to track not only the original loss amount and its character, short, long, but also exactly how much you've used each year to offset gains or ordinary income and precisely how much carryover remains. The IRS can definitely ask for proof of carryovers going back many, many years, so keeping thorough, organized records is vital.
All right, we've covered a ton about U.S. stocks held in taxable accounts. But what about investing internationally? The sources give a quick look at foreign investments and their tax implications.
Right. Investing in foreign stocks or bonds, either directly or through funds, can introduce an additional layer of complexity, mainly because you might face taxes in both the United States and the foreign country where the company or asset is located.
Ah, the dreaded double taxation.
Potentially, yes. Paying tax on the same income or gain in two different countries is something nobody wants.
So does the U.S. tax code have a way to deal with that, to prevent you from being taxed twice?
It does. The primary mechanism the U.S. tax code provides to help alleviate this double taxation on foreign investment income is the foreign tax credit. The sources mention that you generally claim this credit using Form 1116 foreign tax credit.
Okay, Form 1116, foreign tax credit. What exactly does this credit do for me?
Its purpose is to allow you to use qualified income taxes you paid to a foreign country, things like taxes withheld automatically by a foreign government on dividends or interest paid to you, to directly offset your U.S. tax liability on that same foreign income. It's designed so you ideally don't end up paying full tax in both countries.
Is it better to take this tax credit for foreign taxes paid, or could I just deduct those foreign taxes instead?
Good question. The sources clarify that in most cases, opting for the credit is significantly more beneficial than taking an itemized deduction for foreign taxes paid.
Why is the credit better?
Because a tax credit reduces your U.S. tax bill dollar for dollar. If you have a $200 foreign tax credit, your U.S. tax bill is literally reduced by $200. A deduction, on the other hand, only reduces your taxable income. The actual tax savings from a deduction depend on your tax bracket. A $200 deduction might only save you $48 if you're in the 24% tax bracket, for example. So the credit gives you much more bang for your buck.
Okay, credit is usually better. Got it. How much foreign tax can I actually claim as a credit? Is it just whatever amount the foreign country withheld or charged me?
Not necessarily. There's a limit. The amount of the foreign tax credit you can claim in a given year is generally limited. It's the lesser of two amounts. One, the amount of qualified foreign income taxes you actually paid or accrued. Two, the amount of U.S. tax you would owe on that same foreign source income calculated based on your U.S. tax rate.
Can you give an example of that limit?
Sure. The sources give clear examples. Let's say you received foreign dividends and the foreign country withheld $200 in taxes. You calculate that your U.S. tax liability on those same dividends would be $300. In this case, the foreign tax paid, $200, is less than the U.S. tax, $300, so you can claim the full $200 as a foreign tax credit. Your U.S. tax on that income effectively becomes $100, $200 credit.
Okay, makes sense. What about the other way around?
Now, let's say the foreign country withheld $300 in tax, but your U.S. tax liability on that same income is only $200, maybe because your overall U.S. tax rate is lower. In this case, your credit is limited to the $200 U.S. tax amount. You can only use the credit to offset the U.S. tax. You can't get a refund from the U.S. for foreign taxes paid above the U.S. rate.
So in that second example, I paid $300 foreign tax, but only got a $200 U.S. credit. What happens to the extra $100 of foreign tax I paid? Is that just lost?
Not necessarily. In many cases, that excess foreign tax credit, the $100 in this example, can be carried back 1 year or carried forward for up to 10 years to offset future U.S. tax liability on foreign income in years where you might have excess annotation. So like capital losses, there's a carryover provision.
Okay, good to know there's a carryover. Filing Form 1116 sounds like it could be complicated. Is there a simpler way to claim the credit if I only have a small amount of foreign tax?
Yes, thankfully. The sources mention a helpful de minimis exception. If your total creditable foreign taxes paid for the year are fairly small, the threshold is $300 or less for single filers, $600 or less if married filing jointly, and all of your foreign income is passive income, like dividends or interest reported on a 1099.
Yeah.
You might be able to elect to claim the credit directly on your main Form 1040 tax return without needing to file the potentially complex Form 1116. This definitely simplifies things for investors who just have a little bit of foreign dividend withholding, for example.
That's really helpful for small amounts. Now, beyond the tax on the income or gains, are there any reporting requirements just for having foreign financial accounts, like just holding money overseas?
Yes, this is a separate but very important reporting requirement mentioned. If you have foreign financial accounts, this includes bank accounts, brokerage accounts holding foreign stocks, maybe foreign mutual funds, and the aggregate value of all your foreign financial accounts exceeds $10,000 at any point during the calendar year.
Aggregate value.
Yeah.
So all of them added together.
Correct. If that total value crosses $10,000 even for 1 day, you are generally required to report all those accounts to the U.S. Treasury Department's Financial Crimes Enforcement Network, FinCEN.
How do I report that?
This is done by electronically filing FinCEN Form 114, which is the report of foreign bank and financial accounts, commonly known as the FBAR.
FBAR. Okay, is this a tax?
No, the FBA itself is purely a reporting requirement, not a tax. But the penalties for failing to file it when required can be extremely steep, even potentially criminal in willful cases. So it's something to take very seriously if you have foreign accounts over that $10K threshold.
Okay, foreign tax credit for income, FBAR for reporting accounts over $10K. Anything else to watch out for with foreign investments specifically mentioned in the source material?
Yes, the sources specifically call out something called passive foreign investment companies, or PFICs.
PFICs.
What are those? These are basically foreign-based investment funds, think foreign mutual funds, or certain foreign partnerships or corporations that primarily hold passive investments that meet specific technical criteria based on their income or assets. The sources note that the U.S. tax rules for PFICs are notoriously complex and generally result in unfavorable tax treatment for U.S. investors compared to investing in equivalent U.S.-based funds.
Unfavorable. How so? What kind of tax treatment are we talking about?
Well, the specific details get very complicated very fast, often involving filing another complex form, Form 8621, though the source text doesn't mention that specific form number. But the implication from the sources is that the tax treatment is designed to discourage U.S. investors from using these foreign fund structures directly.
Why discourage them?
For example, distributions from PFICs that might look like dividends could end up being taxed at higher ordinary income rates, even if they came from long-term gains or qualified dividends within the fund. There can also be punitive interest charges applied to gains when you sell PFIC shares, effectively eliminating the benefit of tax deferral.
Yikes. Sounds messy.
It really can be. The general takeaway from the sources on PFICs is they are complex, they often have negative tax consequences for U.S. investors, and the IRS rules basically discourage their use. The implication is that it's generally much simpler and potentially more tax advantageous for most American investors to get their international exposure by investing in U.S. domiciled mutual funds or ETFs that invest internationally rather than buying shares of foreign domiciled funds directly.
That makes a lot of sense. Stick with U.S.-based funds for simplicity, even for international investing. Good tip.
Generally a safer path, tax-wise.
Now, throughout this entire deep dive, we've been really focused on investment activities and their tax implications. Schedule D, gains, losses, bases, wash sales. It seems really important to reiterate a key distinction we touched on earlier, just to be crystal clear.
Yes, absolutely. It's worth repeating. The vast majority of the rules and forms we've discussed today, the definition of capital gains and losses, the short-term versus long-term holding period rules and tax rates, filing Schedule D and Form 8949, using capital losses to offset gains and up to $3,000 of ordinary income, the tricky watch sale rule, cost basis adjustments, all of this primarily applies to investments held in taxable brokerage accounts.
Taxable accounts. Okay. How are retirement accounts like IRAs or 401ks fundamentally different in this context?
Fundamentally, the tax reporting mechanics on a year-to-year basis are completely different for tax-advantaged retirement accounts. Within an account like a traditional IRA, a Roth IRA, or your company's 401k plan, the capital gains and losses you realize from selling investments inside the account are generally not reported on your annual tax return. You don't file Schedule D for trades inside your IRA.
No Schedule D for IRA trades.
Okay. The growth within the account, including capital gains, dividends, interest, it's all either tax deferred in traditional accounts, meaning you pay tax later when you withdraw, or potentially tax-free in Roth accounts where qualified withdrawals in retirement are tax-free.
So the buying and selling inside doesn't trigger current tax?
Correct. You are typically taxed only when you withdraw money in retirement from traditional accounts, or potentially not at all from Roth accounts, assuming qualified withdrawals. You're not taxed on the individual buy and sell transactions happening within the account itself each year.
So, just to be concrete, if I sell a stock inside my 401k for a nice profit, I don't report that gain on Schedule D this year.
Correct. That gain simply stays within the 401k, gets reinvested according to your plan choices, and continues to grow tax-deferred or tax-free. It does not hit your current year's tax return. No Schedule D entry needed.
And the flip side, if I have a capital loss inside my IRA because an investment went down and I sold it, can I use that loss to reduce my income tax like I can with losses in my taxable account?
No, you generally cannot. That's a critical difference and limitation. Losses realized within these tax-advantaged retirement accounts cannot be used to offset capital gains you have outside the IRA, nor can they be used to offset your ordinary income on your personal tax return.
So those valuable loss deduction rules just don't apply inside an IRA or 401k?
Correct. That $3,000 deduction, the carryovers, those are benefits tied to taxable accounts. The tax benefits of retirement accounts come from the preferential treatment of contributions, sometimes deductible, and withdrawals, sometimes tax-free, and the powerful tax-deferred or tax-free growth within the account over long periods. They don't come from the ability to deduct internal capital losses annually.
That distinction is huge. Taxable account rules are very different from retirement account rules when it comes to annual reporting of gains and losses.
Fundamentally different, yes.
Wow. This deep dive has really laid out the whole landscape of reporting investment activity for taxes. We've covered so much ground. We went from the basics of defining gains and losses, figuring out that crucial short-term versus long-term distinction based on holding period.
The 1 year plus a day rule.
Right. Then through the necessary paperwork, understanding Schedule D and its partner Form 8949, and when you might simplify things with the 1099-B. We explored the sometimes surprising complexities of cost-basis stock splits, reinvested dividends, and how those different methods like FIFO or average cost can dramatically change your tax picture in a given year.
Yeah, that basis part is key.
Then we looked at the powerful role losses can play, how they net against gains, that valuable $3,000 deduction against ordinary income, and the loss carryover rules. We navigated the minefield of the wash sale rule, that 61-day window. The disallowed loss, the basis adjustment, the holding period tacking, substantially identical. And that huge pitfall of it applying across all your accounts, including IRAs.
It's the one that gets so many people. Really have to watch that.
And finally, we touched on the nuances of foreign investments, the foreign tax credit, FBAR, PFICs, and hammered home that fundamental difference between taxable accounts and retirement accounts. It's been a lot.
It has been a comprehensive picture, definitely. And each element we discussed is really a piece of the puzzle for accurately reporting your investment activity and understanding its tax impact. I think the core takeaway from this deep dive, really synthesizing what the sources emphasize, is that understanding the tax implications of your investment decisions isn't just some annoying compliance exercise you do once a year. It's actually a key part of being an informed investor all year round.
That's a great point. It affects your decision.
Exactly. Knowing the rules around holding periods to qualify for lower long-term rates, understanding the impact of different cost-basis methods before you sell, recognizing the potential value of harvesting capital losses, and critically, knowing how to avoid costly pitfalls like the wash sale rule across all your accounts. All of this is essential. Not just for accurate reporting come tax time, but potentially for optimizing your after-tax returns over the long run. And as we said, good documentation and proactive record keeping are absolutely your allies in managing all this.
And connecting this back to you, our listener, and your own personal investment journey in tax filing, arming yourself with this knowledge, truly understanding these core concepts, really empowers you. It helps you face tax season with more confidence, less dread. It helps ensure you're reporting accurately, avoiding costly mistakes, and maybe even taking advantage of tax benefits you're entitled to from your investment activities, like that loss deduction. It gives you the map, like we said, to navigate this often complex terrain.
Precisely. It moves you from feeling potentially overwhelmed by all the forms and rules to feeling much more in control of this aspect of your financial life.
So here's a final thought based on everything we've explored today. Next time you're thinking about making a move in your investment portfolio, especially hitting that sell button on a stock in your taxable account, before you click, pause for just a moment. Consider not just the potential gain or loss for your financial goals, but also how that single decision when you sell, which shares you sell, what you might buy back, could echo through your tax return come April. Every investment move really does have a tax quint. What steps will you take this year, armed with this knowledge, to ensure you're tracking accurately, reporting correctly, and taking full advantage of any tax benefits available from your investments?